We're diving straight into a high-impact call that landed on Wall Street this morning, rattling the consumer discretionary space at a moment when the broader tape can least afford it. Goldman Sachs has formally downgraded Mattel, ticker Mattel, to a sell rating, citing execution concerns that suggest the toymaker faces meaningful operational challenges ahead. This is not a routine valuation trim or a price target nudge. It is Goldman's most bearish available stance, a signal that the firm believes management's ability to deliver on guidance is genuinely in question. That kind of conviction from a top-tier bank deserves serious attention from any portfolio with discretionary exposure. Goldman Sachs's downgrade of Mattel to sell centers on what the firm characterizes as execution concerns, language that translates to a belief that Mattel's operational metrics and forward guidance are failing to meet prior Street expectations on profitability and cash generation. The prior Wall Street consensus had assumed Mattel could sustain margin expansion and revenue growth across its core brands, Barbie, Hot Wheels, and Fisher-Price. Goldman's move implies that actual performance on cost controls and international market penetration is missing those assumptions. The downgrade arrives as the 10-year Treasury yield sits at 4.57%, already a significant headwind for consumer discretionary multiples across the sector. The deeper macro context here is critical. Goldman's downgrade does not land in a vacuum. It lands in a market where the 10-year yield is at 4.57%, up substantially on the session, and the 5-year yield is sitting at 4.31%, up sharply. When risk-free rates are elevated at these levels, equity investors demand cleaner execution and tighter earnings visibility from consumer discretionary companies, precisely because the discount rate applied to future cash flows rises. A company like Mattel, operating in non-essential consumer spending with brand-dependent revenue, becomes acutely vulnerable when operational discipline is questioned. Goldman's call essentially says the risk-reward has shifted unfavorably given both company-specific execution and the broader rate environment. The blast radius extends well beyond Mattel itself. Hasbro faces guilt by association selling, as any institutional investor reassessing toy and entertainment sector exposure will review Hasbro alongside Mattel, given their near-identical demand drivers. JAKKS Pacific is a smaller cap name that could see amplified downside as investors de-risk the toy subsector broadly. At the ETF level, XRT, the Retail Sector Fund, and IYV, the Consumer Discretionary ETF, both face headwinds as toy and entertainment demand softness flows through to retail sentiment. The broader market is showing weakness, suggesting consumer names are feeling acute pressure this session. Investors should track several key catalysts with precision. First, the 10-year yield at 4.57% is the macro ceiling pressing on discretionary valuations. Any further yield rise tightens the vice on Mattel's multiple and its peers. The 5-year yield at 4.31%, elevated today, adds a recession signal dimension through spread dynamics that historically precede demand deterioration in non-essential categories. Second, Mattel's upcoming Q2 and Q3 earnings reports become high-stakes events. Watch specifically for margin guidance, international revenue commentary, and any cost savings updates. If management cuts guidance or misses on those operational metrics Goldman flagged, expect XRT and IYV to absorb further institutional selling alongside Mattel. Goldman's sell on Mattel is a precise, tactical red flag for every portfolio carrying consumer discretionary exposure. The combination of company-specific execution doubt and a 10-year yield sitting at 4.57% creates a compounding headwind. Valuations compress on the rate side, while earnings expectations deflate on the operational side. Unless broader consumer spending data stabilizes materially and Mattel's management delivers a credible execution recovery, the path of least resistance for Mattel, Hasbro, and sector proxies like XRT and IYV is lower. That is the single most important story for discretionary investors today, and it is the story that closes out our coverage this session. If this kind of deep dive, analyst-level market coverage is what you need every trading day, hit subscribe right now and turn on the notification bell so you never miss a breakdown. Every session we go further than the headlines, tickers, levels, catalysts, and the macro context that actually moves your portfolio.